Thank you. All right, let's go ahead and get started. Hi, everyone. For those of you who don't know me, I'm Amber Anderson, and I work for the Utah State Historic Preservation Office. I manage the Historic Rehabilitation Tax Credit programs. I assume you can all see my shared screen. If someone on the panel could just nod. Great, thank you. We are happy to have you all here today. Just so you know, we are recording. If you didn't hear that, we are recording this. So if you end up not being able to make it for the whole time, or if you know of somebody who would have loved to be here but couldn't, we will make sure to get this recording available to you at a later date so that you can rewatch it or share it. We would be happy to do that. This is a webinar format. So in order to ask questions, you will see a Q&A area. I believe it's at the bottom of your screen. If you could put your questions in there, that'll help us keep them organized. There is also a chat function, so feel free to interact with each other, make comments over there. We'll also try to keep an eye on that for questions, but the Q&A area helps us keep things straightened. And then we will take breaks for questions after each person speaks. So you will have the ability to raise your hand and be unmuted if that is something you would like to do. One caveat before we get started is if you did sign up expecting a presentation about preservation best practices, the historic preservation standards, preservation treatment options, this isn't that webinar. This is going to be a webinar more about the financials about historic tax credits, how they can help you with a development that you're working on, how to make them pencil better, make more profit, things like that. So we're going to be looking at financials. We do have trainings on the preservation standards, preservation treatment options, things like that. I believe we have them on our YouTube, but if we don't, we will have those at some point in the future. So feel free to reach out if that's something you would like to learn more about. Let's see. Okay. So just a little preview of what we're going to talk about today. I will go through some of the basics of historic tax credits first for those who aren't familiar. And then we're going to jump into a couple of great speakers who have development experience with the historic tax credits. First, we'll have Steve Graham, who is a developer and consultant, talk about leveraging the historic tax credits with different incentives like low-income housing, solar, energy, things like that. He recently had a very successful project up in Logan that he'll talk about, the Borden Lofts. And then we will switch gears to Greg Gossard and Laura Core with the Hampstead companies. They will be talking about twinning the historic tax credits with low-income housing or LIHTC credits, as well as opportunity zones. They had a successful project, the Jackson Apartments in Salt Lake City, not too long ago that you may be familiar with, that they will be giving you a case study on. And then last but not least, we will have David Amott from Preservation Utah speaking about the future of Utah's state historic tax credit and potential for expanding it. So stay tuned for that. And then the last disclaimer is that none of today's content should be taken as tax advice. We are not your trusted tax consultants. You should consult with somebody who understands your situation if this is something that you are interested in pursuing. These are some of the other incentives that can be used well with historic tax credits. We are going to be talking about a few of these, but it's just important to know that there's a lot out there that can be used in conjunction with the historics in order to help facilitate projects and the preservation of historic buildings. Okay, now we will jump into historic tax credits 101. Before we get into the meat of it, it is important to know the different code and rule references, or at least have someone on your team know them. So for the state credit, there's a code and some rules, federal credit listed below. It's important to understand the specific details of the different programs if you are going to be undertaking a large project. Okay, so we have two historic tax credit programs available here in the state of Utah. One is a federal program, one is a state program. They both provide a tax credit, not a deduction, equivalent to about 20% of a project's costs. And we will get into what that about means on the next slide. But it's a credit, not a deduction. So a credit is better. A deduction reduces your taxable income and thereby reduces your tax liability or your taxes owed throughout or at the end of the year. A tax credit is a dollar for dollar reduction in those taxes owed. So it's more valuable than a deduction. The state program is for residential properties and the federal program is for income producing properties. And income producing can include residential rental. So if you have a project that qualifies for both state and federal, a residential rental project, there is sometimes the opportunity to get a combined 40% tax credit, half state, half federal, and both of the projects we'll be looking at today were able to do that. In order to participate in either the state or the federal historic tax credit projects, a building has to be listed on the National Register of Historic Places, either as an individual listing or as a contributing property in a listed historic district. The building does not have to be listed at the beginning of your project, but you should be working pretty closely with our office and our National Register coordinator to make sure the building will be eligible for listing, because we don't want you to get 2 years into a project assuming you'll be eligible for tax credits and then have the building not be eligible for the National Register in the first place. I do want to point out for people who aren't super familiar with our office and our programs or the National Register that listing on the National Register of Historic Places in and of itself does not come with any property restrictions. That's a common misconception. You can legally list a building on the National Register and tear it down or cover it in vinyl siding the next day. There is no law preventing you from doing that. The local listings, like Salt Lake City's local landmarks, those are where property restrictions come into place. The only time the National Register listing will come with restrictions is if you choose to participate in an incentive program like the historic tax credits that we're going to talk about today. But even then, the restrictions are only for a couple of years after your project. Another requirement that both the state and the federal historic tax credit programs have is that all of the work being done to the property has to follow the Secretary of the Interior standards for rehabilitation. These standards have to be met on the exterior of the building, on the interior of the building, and anywhere on the historic property boundary of the property. We aren't going to go into detail about those. Like I mentioned, we do have trainings on how to follow those standards and preservation best practices. We've done those in the past, we'll do them in the future, and we have them recorded. But essentially the standards help us to identify what the historic character function, historic character defining features of a building are, and then promote the retention or their preservation. So sometimes we have to replace things, but they need to be really good matches. Sometimes we just need to keep the historic features, and those character defining features could be anything from the floor plan and the scale of a building to the siding materials and the windows themselves. It kind of just depends on the building. And then lastly, the two historic tax credits, the state and the federal, currently as they stand, cannot be transferred in any kind of traditional way. They can't be sold. So there is a process that you'll hear a little bit more about from our speakers today called syndication that allows an investor to become involved in a project, provide upfront capital to an applicant in exchange for the credits, but it's not just a direct transfer or sale in a simple way. Okay, so I mentioned that the tax credits provide a credit equivalent to about 20% of your costs. So it's 20% of your qualified rehabilitation expenses. And the qualified rehabilitation expenses are the majority of your costs, but it's not everything. So on the left-hand side, you'll see an example of what a qualified rehabilitation expense or QRE includes. So it's most of the work you're doing to the historic building itself, all the MEP, replacing the roof, restoring the windows, things like that, as well as soft costs like architect, engineering, and construction fees. Those are all things you can use to calculate your credit. On the right-hand side, you'll see some of the non-qualified expenses. So the purchase price of the property, building an addition, site work, landscaping, and then some of the stuff that you could easily take with you when you left. It is important to note, however, that QREs are defined differently between the state and the federal programs. So those legal code and rule references I listed further up, those will help you determine how exactly that works differently between the state and the federal programs. It's good to know what you're actually going to be getting credit for from an earlier on in your project. So briefly looking at the state historic credit here in Utah, as mentioned, it's for historic residential buildings. You only have to be spending a minimum of $10,000, which, as we all know, is pretty easy to do on any building, but especially an older building. You have to spend that minimum $10,000 in up to a 3-year period from when we review and issue your project pre-approval. You can do it in fewer than 3 years. You can spend far more than $10,000, but you have to spend at least $10,000 in that 3-year period. Currently, there's no limit to the number of projects that you can do, consecutive projects. So you could do a $10,000 project over 3 years, close it out, open a new application, start a new project, do a $20,000 one in 1 year, and then just repeat the process. There's no limit currently as to how many you can do. After you are given final approval for a state tax credit project, you have to continue to follow those preservation standards for 3 years after the project. Once those 3 years are up, if you're not continuing to apply for the credit, you're free to do whatever you want with the building, really. So the last bullet here has to do with the fact that the tax credit is considered non-refundable. So both the state and the federal are non-refundable, which doesn't mean that you don't get the credits back as a refund, but you very well may get them back as a refund. Non-refundable just means that you can't get more back in a year than your annual tax liability. So say for instance, your annual taxes owed throughout the year at the end of the year are $5,000. If you're issued a $6,000 credit, you can only claim $5,000 1 year, but then you can carry forward the remaining $1,000 to the next year. And at the state level, you can carry forward credits for up to 5 years if you need to do so. The federal credit is for income producing buildings. So like I mentioned, that can be residential rental, but it can also be office, commercial, restaurant, event space, anything that has an income producing use. The federal program requires that the project meet the substantial rehabilitation test, which we'll go into a lot more detail on the next slide. The program also requires that you maintain ownership of the property for 5 years and compliance with those preservation standards for 5 years following the project. The state credit doesn't actually have an ownership requirement, but it would be pretty difficult to maintain compliance with the preservation standards for 3 years if you didn't own the building. So it's kind of a weird loophole, but they are different at those two and the two programs. The federal credit used to be, prior to the 2017 tax reform, it used to be that you could claim the whole credit in the first year if your tax liability was large enough. So like I said, it's non-refundable, so you could only claim up to your tax liability in a year. And in 2017, if you had a large enough tax liability, you could claim the whole credit. But that changed, and now you have to claim it over a minimum of 5 years. You used to be able to roll it forward for 20 years after that first year. You can still roll it forward after your 5 years, so that additional 16 years for your total 20 carry forward amount. But it does make it so you can't just take advantage of it as quickly, which can have a slightly devaluing effect on the credit. Okay, so this is the substantial rehabilitation test. And those of you who I've worked with a lot in the past, primarily consultants, I would say, pay attention to this slide, because I just did a couple of weeks ago, did a training with the IRS and the National Park Service. So some of this stuff was actually not entirely new to me, but it's a lot more clear to me now. So I want to make sure that everybody understands the details of this. So the simple test is that your project the cost of your project has to exceed the building's adjusted basis. And just jumping forward to the next slide, this is the adjusted basis calculation. So A minus B minus C plus D is adjusted basis. Your project has to exceed whatever that amount is. If it's a recent purchase, it's just A minus B, purchase price of the property minus the value of the land. So we're really looking at the value of the building. If you've owned it for longer and haven't put a lot of capital improvements into it, your adjusted basis might be a lot smaller. If it's a recent purchase, it's probably going to be a lot larger. But so the basic is you have to be exceeding that adjusted basis. The next point is that you have to be exceeding that adjusted basis based on your QREs. It's not just based on any project costs, which makes sense. You can't use your purchase price of the property in order to see whether or not you're meeting the adjusted basis requirement. Typically, you have to meet this, you have to be re-spending the adjusted basis within a 2-year window. And that 2-year measuring period can be selected by the applicant. You can move it backwards or forwards, depending on whatever suits you the best, whatever makes it easier for you to achieve that requirement. Some people are familiar with the fact that there is also an option for a 5-year measuring period, a 60-month measuring period, but you may not be familiar with the fact that there are actually specific requirements for electing that 5-year period. And so the first two here go together. A written set of architectural plans and specifications for all phases of the rehabilitation must be completed before the physical work on the rehab begins. And there is that caveat that says if the written plans and outline and describe all phases, that will be accepted. How detailed those plans have to be is kind of up for debate. Our contact at the IRS didn't really have a lot of clarity on how specific they have to be. In the past, I know that we have had people just give a very brief description of all the phases at the beginning of the project. That has seemed to work okay in the past, but it's hard to say if that's actually how the law will be interpreted always. So I would say to take these requirements to your legal counsel, to your CPA, and make sure that they understand and feel confident in whatever you're providing if you feel the need to elect a 5-year measuring period. The last requirement is just that it can be reasonably expected that all phases will be completed, which hasn't really been a big issue in Utah projects that I'm aware of. But the next point actually was the biggest clarification on my end, so it might be for you as well. As long as you are meeting the adjusted basis test based on the beginning of your elected measuring period, you can claim expenses as far before that measuring period as you want to. There's nothing in IRS regulations that say you can't claim work before the measuring period. So you just have to keep in mind that any expenses that occurred before the measuring period are going to be factored into the adjusted basis calculation, which has to take place at the beginning of the measuring period. But if you've just been doing small projects for years up until your 2 or 5-year measuring period, you can meet the adjusted basis requirement during your measuring period based on beginning of your measuring period. There's nothing that prevents you from claiming years and years before that. You are allowed to claim after the measuring period, but only till the end of the year in which it ends. So this is slightly different from the understanding that has been had in the past, that your project costs need to fall within that measuring period in order to claim them. They don't. You just have to use that as your substantial rehab test. That's the only point of the measuring period. It doesn't mean you cannot claim the expenses outside of it. So kind of makes the 5-year measuring period a little bit less necessary, in my opinion, depending on the nature of the project, but important stuff to know. Just a little recap of the program differences. I won't read through all of these. The thing I mostly want to point out is at the end. The state tax credit program is administered primarily through our office, the State Historic Preservation Office. We do the review, we have the final say, we deal with the first round of appeals if that happens. But the federal credit is administered by the National Park Service. They have the final say. We serve as a kind of a liaison between the NPS, or the National Park Service, and the State Historic, and the applicant. So I work with the applicant to make sure they understand the program, to make sure they understand preservation treatment options, to help them get everything to the point where we can submit it to the National Park Service. And then I'm also the eyes and the ears on the ground for the National Park Service. If they don't quite understand something or they think something's a little fishy, I can help bridge that gap between the applicant and the National Park Service, who is back in DC and reviews multiple states. So they don't have the time to get into a lot of the details. We're not going to go deep into the application process for either of these, but here's kind of a preview. The state program has essentially a before and after application. This application does have our old logo on it, so that'll be changing in the near future, but it should look pretty similar. The before application is where you just demonstrate a building is listed on the National Register, or will be, and where you propose your work plan, show the condition of the building when you started. That's how we review whether or not it meets the preservation standards. Part 3 is the after application, when you demonstrate that you did what you said you were going to do, hopefully. Hopefully is the keyword. But it's also important to note that the way that the state tax credit legislation is written, it currently requires that you have this before application approved before you finish your overall project. So you can't come to us with a 100% completed project and want to apply retroactively. You can have already started on the project, even though that's not recommended because it's much riskier, but you can't come after everything is completely done. The law does not allow for that. The federal program is a little bit more complicated on the application side of things. There's 3 parts sometimes. Part 1 is not required if a building is individually listed on the National Register of Historic Places. So the Part 1 is where you either demonstrate that a building should be considered contributing to a listed historic district, or where you start the National Register nomination process if that needs to be done. The Part 2 is arguably the most important of either the state and the federal application. This is where you document exactly what you started with, current conditions of the building, thorough photographs, drawings, things like that, and then you propose in detail what you plan to do for the project itself. In detail is an important part of that. We need to understand exactly what you started with and exactly what you're going to do so that we can evaluate whether or not the work will meet the preservation standards. And of course, things change. There is an amendment process that we can work through as well if need be. And then again, the after application is just showing what you actually did, which is hopefully what you said you would do. Review times vary a little bit depending on what you're doing. If you're just applying for the state program, we in our office have 30 days to review the application. We try to take much less than 30 days. I don't like for it to really go over a week if possible, but legally we do have up to 30 days if we're just extra busy. If you are applying for the federal program, if you're applying for state and federal, we don't require that you submit 2 applications. We accept the federal application in lieu of the state if you're going for both credits. But the federal process, we also have 30 days at the SHPO at the state level in order to review the first draft of the application. And then the National Park Service also has 30 days. We like to take less than 30 days. The National Park Service usually takes at least 30 days. And then there's usually a fair amount of back and forth in between the two. And that's kind of up to you how much you want to do that. My goal is to make your application as approvable as possible. So my comments will hopefully allow the National Park Service to review your application more quickly and get you, an approval. But if you don't want to take my advice, don't want to take my comments, you are welcome to just request that we forward it on as soon as you submit it. That's allowed. Maybe not advised, but allowed. And then also, if you do need to get the building listed on the National Register of Historic Places, like I mentioned earlier, it doesn't have to happen before you start the project, but once you do get that nomination started, and it can be done concurrently with the tax credit application, you don't have to finish one before the other necessarily. Our office has 45 days to review the National Register nomination draft. That is, we do have a National Register coordinator. He's who you would work with, Corey Jensen. And then once you have agreed that you want to send it off to the National Park Service, they have an additional 45 days. So if this is something you're interested in, honestly, the first thing I would recommend that you do is just to reach out to us. If you think you might be interested but aren't familiar, we can have an initial conversation to figure out which program might be the best for you. If not both, we can make sure your project is going to be a good fit for these. It's going to maybe meet the preservation standards. And then we can just make sure you are set it out on the right track in terms of your project scope and the application. If for some reason you choose not to communicate with us beforehand, which I don't recommend, thoroughly document the building before starting any physical work. This is the only way that we're going to be able to evaluate whether or not the work you do is meeting the preservation standards. If we don't know what you started with, we don't know if the work you did met the standards. Projects have been denied based on not enough prior documentation and then not working with us before starting work. But then lastly, just start the application process as soon as possible. Communicate often, communicate early. This is the only safe way to proceed with having a successful tax credit application. Lastly, I have some resources for you here on the left-hand side. It's kind of just the program website, state program, federal program. The IRS information for the federal program is quite a bit of helpful information in the FAQs. The IRS information, the third link down, does have some topical tax briefs where they get more into things like qualified rehabilitation expenses. And then on the right, I have kind of just some random links that might be helpful. The National Trust for Historic Preservation does have an investment arm. That's the National Trust Community Investment Corporation. They provide guidance, but they also do play the role of an investor in historic tax credits, low-income housing, solar, new markets, a bunch of different tax credits that work well with historics. they can play the role as investor. Lots of other places can also play the role as investor, as you'll hear from our speakers here shortly, like KeyBank, American Express. There are others, but I just wanted to point that one out because it's not an obvious option, I would say. Novogradac is also a great resource. They have a lot of guidance. They also provide financial consulting that I think Laura and Greg will probably talk about just a little bit. They have information on tax credits, legislation, the programs in different states, all those kinds of things. And then Heritage Consulting Group is a tax credit consultant. But this link that I've included here it's essentially their blog page, and they have a lot of different special topics that they cover here that are interesting to read through, as also provide inspiration for different projects. Here is my contact information, and we can go ahead and answer or open it up for questions if there are any. Alina, I don't know if you've seen any. I see the one from Zach. I can answer that one. Is the NPS still backlogged? I would say no. They just hired a bunch of reviewers and got them up and going. So their review times have been pretty close to 30 days, sometimes less, sometimes a little more, but they're not as backlogged as they were a year or two ago.
Amber, there was a question that we discussed in the chat during your session talking about a historic library owned by the city. You know, could that use any of the tax credits?
That's a good question. So in order to meet, it would not meet the state program, obviously, because there's no residential use. In order to meet the federal program, there would have to be an income producing use. So there's two issues. Is there an income producing use, which there may or may not be with something owned by the city, with a library, so you'd have to determine that. The second issue is the owner actually going to benefit from a tax credit? If they don't have a tax liability, they might not. They may be able to work with an investor who would benefit from that, but you would still need to figure out if the building itself is going to have an income producing use.
All right, thanks. And then we have a hand raised from David Shear. So I'm going to unmute him so he can talk.
Can you hear me okay?
Yes.
Okay, great. I also typed this in the box. You talked about written description, and it's not clear to me whether that means full architectural plans and specs, or if there's some lesser degree of detail that can be submitted at some point.
It is not clear to me either, David. When we met with the IRS, our contact at the IRS is only legally allowed to point to previously written guidance. So the guidance that I shared in that slide, I can pull it back up if that would be helpful, but that's as much guidance as we officially have. That's why I would encourage you to talk with a tax professional and see if they feel comfortable with whatever it is that you have. The other thing that you can do, the IRS has a means where you can get a private letter ruling. I do think that you probably could go through the private letter ruling process to get this question answered. It's where they go through case law, they figure out what the answer would be, but it's not something that's publicly available. So the only thing that we can encourage you to do is to have a tax professional look at what you have and see if they feel comfortable with it.
Okay, thank you.
Unfortunately.
All right, and then 2 more questions in the chat, Amber, if we have time. From Heidi, she says, do fines count as income?
I don't know. That's something you would need to talk to a tax professional about.
Okay. And then Brian asks, how could I find out more about syndication?
Well, I think our presenters are going to talk about it a little bit. And if their presentations don't have it, I will prompt them to talk more about it at the end. Because yeah, I think they'll be a good resource for that.
All right, that's all the questions I'm seeing right now. So I think we're good.
Okay, great. All right, so next up we have Steve Graham. Steve, when you are ready, take it away. Hi. There you are.
Yeah. Well, welcome. That was great. I wish that I had even that overview before I got started in this business of storks. I'm Steve Graham. I have done some historical preservation work using the historical tax credit, and I'm continuing to do some. I hope it succeeds. But I'm going to talk to you today. I think Greg and my presentations will overlap a bit, but it doesn't hurt to see it from two different perspectives. So I'm going to talk about leveraging the credit with other resources, basically other credits. And let me share my screen here. There, how's that? So, I primarily have leveraged these tax credits, the historic tax credit, with a low-income housing credit, and also though with the renewable energy credit, and that's what we'll talk about. And I believe Greg has done the same. I believe he did it in a different approach, and I look forward to learning about his approach. Meanwhile, I'll show you mine. So a real quick overview, but it's repeats some of Amber's stuff. It was the historic credit was established in 1976. It was initially a deduction, and they revised it in '78 to a tax credit. Used to have a nice little 10% credit for non-residential, non-historically certified, and not in historic districts, but that was removed. In 2017, they terminated that 10% credit. We were able to get another project in just under the line on that 10% credit. And they also, as Amber mentioned, spread out the taking of the 20% credit from 1 year to 5. The project that you'll see later in this, we were able to get it in under the line to be able to qualify for the 1 year credit taking. But anything going forward now would be 5 year. Okay, the historic tax credit is generally an economic yield-based transaction in most situations. An investor or somebody is seeking a return on their investment. And that has to have an economic return. It has to be, it's evaluated against other investment opportunities. When you're using the historic credit primarily by itself. That changes a bit when you move it into the low-income housing tax credit arena. So a little overview of the low-income housing tax credit. There are two types of credits. There's a 9% credit taken from an annual state allocation, and it's a competitive process. While I say that, there is a component in if you have a building acquisition and rehab, you will only get 4% credit on the acquisition, 9% for the rehab expenditures. But all of that, it comes from a limited pot of funds that are allocated to each state based on the size of the state population each year. You have to compete for that, and you must follow the competitive process, the allocation plan established by Utah Housing Corporation, which is a quasi-governmental entity here in the state of Utah, administering our state's plan. Each state has their own entity administering their state plan. There is also a 4% credit available in conjunction with the state tax-exempt bond authority. It's really federal tax-exempt bonds issued by the state. Every state gets a certain amount of bonding authority by the federal government, which allows the state to allocate, issue tax-exempt bonds for various purposes. They can be used for student loan programs. They can be used for single-family mortgage programs. Multifamily, which is where we use the 4% credit in conjunction. Some industrial bonds and things such as that. That's a limited amount of bonding authority each state has. The 4% credit available is unlimited because it is de facto limited by how many bonds the state will issue towards multifamily properties. In the state of Utah, you won't get a bond for multifamily unless you are also going to be using the 4% credit. These credits are available only on low-income restricted units of your project, but you must have a certain minimum amount of restricted units in the project to qualify at all for credits. So you'll be multiplying your eligible basis, your overall cost, by the fraction of the restricted units to get to a qualified basis, and that qualified basis is what you will have your tax credit calculated against. This is an annual credit taken for 10 years. So a 9% annual credit effectively is going to provide a tax credit on 90% of the qualified basis of your project. And on the 4% would be a 40% of the total credit on the qualified basis. And that's a pretty big credit. It is taken over 10 years. The restriction periods are much longer than the historic credit. The minimum restriction is 15 years, and actually it's 30. There's now pretty much a waive the right to take it out of the program for 30 years. And most states require greater than that, and you get points for that. And in the state of Utah, you pretty much have to be over 50 years to win credits. But in exchange for that, you can see that you get a substantial amount of credit and therefore a substantial amount of investment. It's very important though that, and I want to bring this up because I've had a bad experience with it. If you're going to use tax-exempt bonds to do your project and the 4% credit that comes from that, those bonds must pay for, there's what's called a 50% test. They must pay for 50% of the eligible basis in the project, not the qualified, but the eligible basis of the project. And you can run into problems if you did not carefully consider your budget at the start. And the state of Utah is not going to give you any more bonds than necessary. And they're going to be looking to see that you are holding that to probably not more than 60% of the cost so that they can spread those bonds to other projects. Well, if you don't do a good job budgeting your costs and you go over after those bonds have been allocated and issued, you could run into a problem in which you did not, in fact, pay for at least 50% of the costs with the bonds. You would qualify for the historic credits that come with it, but you would not qualify for the low-income housing credit, and that can be devastating. I'll get into that a little more later. So anyway, going on. A little bit more about the federal LIHTC, low-income housing tax credit, and a bit about CRA. The low-income housing credit investment helps satisfy the Community Reinvestment Act requirements that banks must meet. CRA, if you're not familiar with it, is a response to adverse bank behavior in the 60s and 70s. The CRA requires regulated banks, those offering insured deposits, to reinvest in low-income areas. And the CRA creates a demand for the low-income housing credit. The LIHTC investment is often an other than just economic investment because of the CRA. So you might get better pricing on those credits than you would otherwise expect to get if somebody was just expecting just an economic return. You were to go off to your a local group of private investors and ask them to buy these credits, they might be seeking some type of double-digit return yield on these, and would pay you a very, a fairly minimal amount on those credits. But if you go to a regulated bank or through syndicators to these banks, you would get a much higher price because they, one, understand the safety of the credit, and they are looking for ways to make investments that meet the CRA criteria. The low-income credit is investment is an automatic CRA compliant investment. There's no selling, no arguing needed to convince regulators. It's automatic. So that is a vast improvement, creates a vast improvement on pricing on these. The historic tax credit investment is not an automatic CRA investment. It's only unless the investment is part of a LIHTC investment. So that's where a great deal of our leveraging happens. The fact that the historic tax credit can become an automatic CRA qualified investment if it is done in conjunction with the low-income housing credit, boosts the pricing of those credits tremendously. You might have realized 80 cents on the dollar in a purely economic standpoint, and you might get 95 on a low-income housing credit one, and you'll see later we got even over $1 on one. So that makes a huge difference. The fact that the historic tax credit is used with the low-income housing credit. There is another credit that we use, the federal renewable energy tax credit. It's often considered just an investment tax credit, so ITC. It provides 30% credit on capital expenditures with respect to a renewable energy project. It's available to residential and commercial properties, and it is taken one time. And it does not need to be spread out over any period of time. And we employed that on this project. Unfortunately, when we completed our project, that credit had dropped to 26%. But under the recent Inflation Reduction Act, it will go back up to 30%. So that's a good deal for anybody who wants to combine this with the historic and the low income. Okay, and then we have state tax credits, piggybacking on the federal. You have the state historic credit, 20% of the QRE. And I said if the project receives a 20% federal, I'm not exactly certain that they have to. Amber will have to correct that, but it was always my understanding that you pretty much had to, or you would, in order to meet the states. It was limited. Am I wrong on that? It was income properties. So our multifamily properties qualify, and it can be taken in a single year. The state low-income housing credit is a gap. Is a state program that's really set up to be gap funding for federal low-income housing tax credit projects, or otherwise assisting for specific, deeply targeted or specific types of projects that the state of Utah wants to see happen, and in conjunction with the federal low-income housing credit. It is limited by Utah Housing Corp through their annual qualified allocation plan. This is the same entity that allocates the federal credit for the state through that same qualified allocation plan. They allocate credits once a year for the 9% credit, but they can allocate state of Utah credits more frequently on a case-by-case basis. It is taken, the state credit, the low-income housing credit, is taken over a 10-year period. We used to have a state renewable energy tax credit, but it is no more. So that's unfortunate. So we can combine these credits, but it takes a little juggling of basis. When I talk about basis, these are your costs that have been incurred in the project. All of these credits can be combined in a single project, and 100% of the federal credit, though, in a traditional project, and I think we'll hear differently from Greg, maybe not, but that credit must be deducted from the basis, your low-income housing tax credit basis, under the understanding that if you're already getting a tax credit of that amount, then you shouldn't also be able to get deduction or depreciation on that same money. But it's not that you have to remove the historic QRE or basis for the historic credit. It's just the actual calculated credit that you would receive, the 20%, that has to be removed. And then if you use the federal energy, should be RETC, renewable energy tax credit, 50% of it must be deducted. Why they came up with 50%, I'm not exactly certain, but that is the rule. So these basic deductions are particularly important on bond projects because unlike the 9% project, the bond project, you get more 4% credits for every additional dollar that you might have expended on the project, as long as you still meet that 50% test. On the 9%, you make an application for those credits and you get a certain amount of credits and that's it. So if you go over your costs, you don't get any more tax credits for those. If you go over your costs by a certain amount, you may very well be able to deduct your historic tax credit from basis and still not adversely affect the amount of 9% credit that you got. But that is not the case in the bonds. Each one of those dollars will reduce those the 4% credits. The basis deduction affects LIHTC credit calculation, and it also affects the depreciation. All of these things go into the investor yield calculation, so it can have effects on what they will be paying for the credits and such. So we have to track the basis when we're combining these. The historic tax credit basis is essentially the QRE, or the qualified rehab expenditures that Amber mentioned. And she went through in greater detail on these, but definitely it excludes your site costs. It excludes new volume to the building. If you, I'm working on another project right now, and we're digging out a crawl space and creating a basement. Well, that basement would be new volume to the building, so those costs are not likely to be part of the QRE, qualified rehab expenditures. It excludes certain items of short depreciation, some personal property, etc. It excludes specific targeted items. Cabinets are excluded, and unglued floor coverings, which are, so tacked carpet is not considered permanent. So you will make decisions on what type of floor coverings you put in based on what would and would not be QRE. But it does include the alternative energy systems that, but provided they are for the building use and not just for generating energy for sale to an unrelated project. Yet net metering is permitted, as they see that more as a method of storing your energy for future use on your building. So these types of net metering, so photovoltaic projects, or a solar water heating system, those would all be considered qualified rehab expenditures to the extent they're servicing the historic building. The renewable energy tax credit basis, it includes the energy production system itself, which would, on a photovoltaic system, would be the panels, the wiring, and all the conduit and everything that had to be put up, the net metering system, all that to utilize that renewable energy. If you use battery storage, the battery storage would be included. If you put those on carports, then the arguments have been made successfully that the carport structure was the support structure for the renewable energy system. And those have been able to be included in that basis. So again, you have to track this stuff carefully so that you, in fact, can get the maximum amount of renewable energy tax credit and historic tax credit and low-income housing credit. So the project that I've been involved in that used all these is called the Borden Lofts, and it's up in Logan. You can see over there a picture of the old Borden Western Company when it was a, this was, I think, shortly after it had been purchased by Borden Milk from the co-op that had run it before then. The picture below it, it shows it in its zombie building state, which it sat in for about 20 to 30 years. And then before we purchased the building and started the process to do an adaptive reuse with preservation. We took this milk plant, which is essentially 3 different buildings, actually 4 combined, and into one building, and we converted it into 51 housing units, apartment units, of which 45 are restricted with the low-income housing tax credit. So I'm showing you here, this is just a simplified source and use that I'll be going through. These were the uses, and you can see that there was land costs, it had to be carved out of the total acquisition. That was $530,000. Those will not receive any credits of either the historic, the renewable, or the low-income housing. They don't get credits. The building acquisition will get the low-income housing tax credit. So it's over in that column. The site work will also get that, but will not get the historic. The direct construction costs, I show here that about 95% of it would be also historic QRE. There was $200,000 that was allocated to the renewable energy credit, and but all $6 million was low-income housing tax credit basis. And then design and engineering was all, a portion of that was available to historic tax credit. Other portion was used on non-QRE related work, so it did not qualify. But all of it did qualify for the low-income housing tax credit. We have profit and overhead there, $1 million there. A portion of that related to the work done for the QRE was historic tax credit eligible, and all of it was low-income housing credit eligible. And then yet in term financing, again, the portion related to the QRE was eligible, and all of it was eligible for the housing credit. And then you have some other costs for your term financing or your tax exempt bonds. They aren't eligible for any of these credits. Some soft costs were not. Syndication of this, the cost of that was not, and the reserves that were required by the syndicator were not. This is simplified. There possibly were some parts of each one of those soft costs and the bonds and all that might have had some eligible basis in areas, but this is a simplified version. So then you ended up with this $11.3 million project. You can see that 7.6 million of it is going to be able to get a historic credit. 200,000 will be able to get a renewable energy credit. And then we have our initial basis for getting the tax credit basis is just under 10.3 million. But now let's calculate that credit on this project. The federal, we would take that 7.6 million and multiply it by the 20% credit, and you will get 1,520,000 in credit. Now you may not get that total amount of money because somebody might not pay you $1 for each of those dollars of credit. The state historic credit will get the same. And then the federal historic credit on the federal renewable energy credit will get 30% of the 200,000. So that'll be 60,000. Now we're going to go to calculating the federal low-income housing credit. But before we do, we'll go back. This is the building now as it's been renovated. And I'll show some more photos of it in a little while. It turned out pretty well. In the front here, these units that face onto the loading dock where the rail came in, those are set up to be able to be used as live work spaces so that the tenant could also operate a business out of those. And I think that we have one person who is an accountant who is also is working out of those. I know that we have a person who is an artist, and she is working out of her unit too. So setting up a little studio in there. But let's calculate the low-income housing credit. We started with 10,270,000 of eligible basis, but we have to remove from that the historic tax credit. We see that there at 1,520,000. And then we have to remove 50% of the renewable energy credit, so that's 30,000. So now we have an adjusted basis of 8,720,000. Now we need to pull out the building acquisition for a moment. And we end up with a base, just 7,350,000. That is our basis that we can then, because we happen to be in a qualified census tract that realized a 30% increase in credit, we are able to take that basis and multiply it by 130%. So now our adjusted basis is 9,555,000, adding back the building acquisition basis, which does not qualify for the 30% boost. You now have 10,925,000 of adjusted basis. Now we started with 10,270,000. We had to pull out that historic and renewable, but that 30% bonus brought it back up to a very nice number, 10,925,000. But only 80% of the project is restricted. And And so we have to multiply that by 80%. That reduces our base, our qualified basis is now just 8,740,000. We have a credit factor at the time, and it didn't show the decimal points, but at the time that we did our project, the tax credit applicable percentage floated as it had since its inception. It was really not so much a 4% credit, it was a 30% present value credit. At the time we did this project, that had dropped to 3.2%. And so that's what we got to multiply the qualified basis by to get to our annual credit. Today, that has been fixed at 4% in the same manner that the 9% credit, which used to float because it was a 70% present value credit, is now fixed at 9%. So, but on this particular project at this time, it was 3.2. And it resulted in annual credits of 281,428. But you get that for 10 years, which means the total amount of credits on the low income is 2,814,280. So that's how we get to the low income housing credit. This was done using the 4% credits in conjunction with the bonds. So now here are our sources that covered the uses. We ended up with a term loan of about 4.2 million. We had a home loan for low-income housing, came in at $1 million. The renewable energy tax credit, you can see that those federal credits, because this was a low-income housing project and went through the syndicators, which I'll get to in a moment, who were looking for CRA qualified investment. We realized $1.15 on those credits. That's pretty good. The historic federal credit, we again, $1.15, and it produced $1.7 million. The state credits were at 65 cents on the dollar, so they produced 988. The federal tax credit was at the $1.15, and they produced the 3,236,000. We also got some rebates from Questar Gas, and that covered the cost, the $11,330. So the big issue here is that if we had done this as just a little historic tax credit project in Logan, the likelihood is that we would have gotten at this time, when we could get all those credits at one moment, an investor would still have only paid somewhere between 85 and 93 cents for those credits at best. And here we were able to get $1.15 because of the way in which they could piggyback those credits in with the low-income housing tax credits, take them all in 1 year at that moment in time, and improve their yield overall. So these work together. By having those federal tax credits in there, it actually improved the yield on the low-income housing credit. And I will say, you will not get this today. This was done a few years back. You will not see these types of pricing, this $1.50. Please take that out of your mind. That, you'll see basically, if this project is in a premier location, you will see between 95 and $1. If it were done today up in Logan, we would very likely see somewhere between 85 and 95 cents on all of these federal credits. So we happen to do this at the high point of the market for purchasing of these credits. It has subsequently dropped for a number of different reasons. A change in the corporate tax rates is one. And they reduced corporate tax rates during the last tax reform, and also some significant changes in CRA qualification that allows the banking sector to look beyond their headquartered areas more readily. And I can get into a little of that, but that's getting back into that CRA. I will just get into a little of that in that Utah is blessed with a very friendly banking governance environment. And we have become a center of excellence for industrial loan banks, industrial loan corporations. And so we have a lot of them. And a lot of national banking firms have set up shop in Utah because over the last 30 plus years, 30, 40 years, we've developed this center of excellence thanks to our state government and their work in the financial regulations and all. And so we had, for many years, a strong demand for CRA qualifying investment lending opportunities because we had so many large banks looking for these opportunities in what is otherwise a relatively small state, low population state. That has been a golden goose. And it offered these wonderful opportunities to these projects. Some of that is falling away because of what I just mentioned, the change in tax structure and CRA, in which many of these banks can now move far beyond Utah to get recognition on their investments. And they are doing that. And thus they are able to get into investments that are more economically driven than just CRA. And so we've seen a dramatic reduction in those prices from these here down into the low 90s, and in the Logan area, we would see them in the 80s. So that did have a big effect, but we had great benefit for many, many years from very favorable banking situation in Utah and the efforts that went into creating that industry here. There's a lot that goes on behind the scenes to make that happen. And a lot of that happened at our state government level. So I'm going to go through a few photos after this, but real quickly, but I just wanted to give a shout of thanks to folks here. Richmond Group was our credit syndicator, and now I realize I haven't really spent a lot of time on that, but I'll do that after this. American Express was our credit investor. UETOD, the Utah Equitable Transit Oriented Development Loan Fund, they provided our construction loan and provided the perm loan, the home loan funds there. That was very helpful to the deal. Rocky Mountain CRC is our term lender. The Private Activity Bond Board allocated the bonds, and Logan City was our issuer. And then SHPO and NPS were our housing tax credit administrators that guided us through the process, even when we weren't always ready to be guided. And I appreciate greatly the efforts put in there to make this a success. you wanted to talk a little bit about syndicators. I'm going to let Greg go after that, since I've taken up so much time, and then I can always come back in later if there's more to be asked or said. These are just going to be some photos of our project. This is a typical unit. This one over here on, let's see, that's on my left. That we call those the trailer park units. They're very narrow. They have that round window is their, that's the living room, dining, kitchen area. And then you go up those stairs there to get to the loft, which you see on the picture to the right. So they're very narrow, but they're great little 1-bedroom units. The bathroom is underneath that stairwell area. These are some photos from the second floor. My partner had some folks come in and do some street art. This is our clubhouse. This is the upper level of the clubhouse. I couldn't find any photos of the lower level. Those doors roll up so that so people can have activities that go out onto the patio if somebody wants to have a larger gathering. But otherwise up here, this is kind of set up to be an exercise area on the upper level. This is one of the public baths, typical. My partner got quite into some of the finishes here. This is another unit. This is one of those that can be a live-work unit. It's a 2-bedroom unit. This the picture to the left is looking from the back door, so to speak, through a little living area, the kitchen, and then all the way through. You would go to the living room, and then the front door off that loading dock, and then the stairs would go up. Well, and you see the front door room and the living room in the other photo. The stairs go up to the bedrooms. There's 2 bedrooms, one on each side. And then this is another of the loading dock / live work spaces. The one on the left, you're looking from the living room to the kitchen, and up above it is the master bedroom loft. It's a very open plan. The picture to the right shows standing in the master bedroom area, and you have a little study office area up there in the loft. Then below all of that is the second bedroom, which depending on how, if it's a couple that chooses not to use that as a bedroom, that can also be an office opportunity. And then we have, these are some pictures of the hallways in the lower levels, some of the old milk plant production equipment. This is the, now this, I'm going to show you some real quick things. This is where SHPO came in and had to help us out a bit. This was, the picture on the left was what we had presented in our final work. And the National Park Service wasn't keen on some of these things, and we had to go back and make adjustments to fill in a grid and take away those blood red, ox blood red doors. Here again, this was a problem in which we had the loading dock doors. Again, we were dumb too. We called attention to it with the ox blood red. But that did not meet the look at all of that period of time, and we failed miserably on that, but we came back in and remediated to create a door that was much more like a loading dock door of that time. And you can see on the 2 pictures on the right how much how it looks using the more appropriate door versus the one where we got carried away. Then we also, we had approval for putting some decks on the back of it, but we got carried away and put a whole metal structure covering the decks, and we had to take those off. The National Park Service was not interested in seeing those. And then we, this is something that if you're going to use a renewable energy tax credit, you want to be very careful. And this one, you can just see a little bit of the panel up here on the picture to the left. Actually, if you were to walk down the street, like the picture on the right is, before we remediated it, you could see those panels. And they basically got in the way of the view of the cornice, so to speak, of the historic building. And that was unacceptable, and rightfully so. And so we had to lower those panels. So they're still there, but they're much flatter, so that they would be hidden from view of the street. So keep that in mind if you're going to put panels on. And then this was another one in which we just had a miscommunication. We thought we were supposed to not make these windows look historic because these were new cut-in windows. But that was just a misunderstanding, and we needed to bring them more in line with the historic by putting a grid in. And then we were permitted to paint the framing. The framing you see here is not to historical standards. It really, it was very good of the National Park Service to let us work with them and remedy this situation with paint rather than, I don't think we really, the way the whole thing was designed, we could not pull it out. But we should have been in communication with the Park Service much earlier on to make sure that this framing style was accepted. And we failed at that, but they worked with us and we came up with a remediation. That doesn't always happen. You're not always going to have an easy remediation. Well, not that this was easy, but that's where it makes a big difference if you are in communication throughout the project with SHPO and with the Park Service. It can make it a lot easier. We took too long. We took a very long time on this project, and for a period of time, we lost communications with SHPO because people retired. We didn't make the efforts that we needed to stay in touch with new staff, and so there was a bit of a surprise when this came in, but we worked through that. In any event, I'll stop there because I think I've taken a lot of time, and I'll let Greg and the others to move on, but I'm more than happy to come back and talk about syndication later if need be.
Hey, Steve, before you go, sorry, so David has some questions. Amber, do you want to take time for it now or later?
Yeah, we can do a quick question with Steve or with David. First, I just want to say thank you, Steve. That was really helpful. It was a great example of how to get yourself in hot water, but we got you out of it. So
yes, I appreciate
definitely
your work there.
A lesson in communicating early and often and doing what you proposed, but also great to see all those numbers. It's super helpful. David, do you want to unmute yourself real quick and just ask a follow-up question?
Yeah, I'll just, I had a few questions. I'll just ask one in the interest of time. Obviously, the entity that claims the historic tax credits has to have a tax liability itself before it can syndicate the tax credits. Is that true?
The syndicator doesn't necessarily have to have a tax liability. There are some nonprofit syndicators, but the end investor needs to have a tax liability. And basically in this situation, the end investor comes in and owns 99.99% of the project. We own 0.01%, but the operating agreements are structured in a manner that the revenue from the project pretty much flows to the managing member. The credits flow to the investor now.
I'm sorry, I'm confused.
Oh,
I mean,
so
you say that by buying the tax credits from the syndicator, an investor acquires an ownership interest in the project?
yes, yes, absolutely. So actually, we have, in this case, we have a partnership between our entity, Borden Management LLC, and Richmond Group, the syndicator. The Richmond Group owns 99.99% of that, of Borden Holdings LLC, which holds this property. And then they have an upper tier partnership with American Express that flows the credits on out to them. But Richmond has that 99% interest, and they watch over the project, and we pay them an asset management fee annually as they manage the asset on behalf of their upper tier partners. Yes.
Yeah.
At year 15, that we would unwind that, and then the project will be held by Borden Management LLC, and the investor would go away. Your operating agreements set forth the terms of that, how much any exit charges would be.
Yeah, that's how the syndication, how it works, because the tax credits aren't just transferable or sellable. That's how the syndication is made possible.
Okay, thanks.
But all right, thank you, Steve. Let's go ahead and give it over to Greg and Laura.
All right. Good morning, everyone. I'm Greg Gossard, the president of the Hampstead companies. I'm here in sunny San Diego. What is normally sunny, but it is actually raining behind me. We've got the remnants of a hurricane from down in Baja California, so it's kind of exciting for us to have a little bit of rain. But thank you to Steve for doing all of the hard work, explaining the technical details of the low-income housing tax credit and a lot about the historic tax credit. So that leaves me with the easier task of regaling you with stories of earthquakes, pandemics, and the nuances of master lease structure and opportunity zones. So it makes my job a little easier here. Laura, we can go to the next slide. And then, so just a little bit about Hampstead. As I said, we're San Diego based. Our focus is on the creation and preservation of affordable housing. And preservation, in our minds, is typically the preservation of affordability requirements. So, we've done about 8,000 units across the country, about 18 states now. We've done 4 projects in Utah. The one that we're talking about today was our second. So this is the Jackson Apartments. So yeah, typically preservation for us is affordable, preserving the long-term use agreements and regulatory requirements of the affordability of the projects. But we do have some experience in preserving historical elements. So Laura, you can go to the next one. So, this little summary of our historic preservation history, and it actually starts with me. When I graduated college in 2001, I took a job at Bank of America buying historic tax credits across the country. So we were a direct investor, buying both federal historic credits and state historic credits. That's kind of where I cut my teeth on these programs and learned some of the structuring nuances, which we'll cover here. But we did everything from the Ferry Building in San Francisco, which is both office and retail use, to loft apartments in LA, to a food hall in Asheville, North Carolina. So I've seen a lot of different uses for both federal and various state historic credits. Then we, here at Hampstead, once I jumped to a development firm, we've done, I think, what is now 5 projects that involved the federal historic credit and quite often state historic credits. projects in Washington, D.C. don't have a state historic credit, but in Maryland, there is one. And obviously in Utah, there's a historic credit, which made the Jackson apartments possible. I will kick it to our project manager, Laura Core, to discuss some of the intricacies of the building itself and some of the hurdles that were put in front of us as we try to get started here. So go ahead, Laura. Go ahead and talk about the historic nature of Jackson.
Great, thanks, Greg. So obviously Hampstead's experience in preserving historic properties proved to be very helpful. And the community that we're highlighting today is Jackson Apartments. It's an 80-unit community set aside for seniors 55 and older, earning 60% of AMI or less. And it's located right in the heart of downtown Salt Lake City on 200 South and John Stockton Boulevard. So fabulous location. But just some fun facts that I wanted to share with you guys as we really dug into our historic research on the building. It was built in 1916. It was constructed on the city's former jail site, which I thought was funny. And really, Jackson is historic because it's located in the National Register of Historic Places as part of the Historic Warehouse District, which is kind of a boundary outlined in this neighborhood of downtown Salt Lake City. And originally, this property was two buildings known as the Fillmore Apartments and the Uinta Apartments, or together as Fillmore and Uinta. And it was formally renamed Jackson Apartments in 1946. So this picture that we have here to the right is actually a photo from 1936 found in the county archives, which is really neat to see what that part of town looked like back then. So we acquired Jackson in January 2020. And, you know, we're in the process of putting together our financing and really fine tuning what our substantial rehabilitation scope of work would look like. And, you know, of course, we've got an unreinforced masonry building here. So we knew we would need to do some seismic upgrades, such as the chimney stood at 12 feet tall. So we needed to bring that down to a safe level at 5 feet above the roof line. We needed to brace the parapets. And then we were going to tie in the unreinforced masonry walls to the roof line. Well, something that we can all relate to. First, we had a pandemic hit in the middle of March, which already felt like, you know, doom and gloom a little. Then, right after we were sent home, I remember this perfectly, to start working from home. Utah had one of the largest earthquakes it had had in 100 years of a 5.7 magnitude. So as you can clearly see by this slide, the earthquake had a significant impact on Jackson. And still I consider ourselves lucky because I saw pictures after that earthquake and there were definitely other buildings that had it worse than us in town. So this picture here on the left is the chimney after the 5.7 magnitude earthquake, which, you know, clearly a hazard. We needed to emergency temporarily relocate the residents that lived below the chimney, just in fear that if that thing tumbled, we needed to make sure that everyone was safe. And then it wasn't that much later that we had this aftershock. And I can only somewhat chuckle and say, this looks like a Jenga game with the blocks just ready to be pulled out one by one because everyone was safe. We were able to safely take down this chimney in one piece miraculously. They basically braced it and wrapped it and brought it down. So this just had a slight impact on the seismic upgrades we had planned for our scope. In addition to the items that I mentioned earlier, we needed to then take the roof down actually about 10 feet below the roof line here. So that way we could remove all of the kind of deteriorating brick and then fully rebuild it to 5 feet above the roof line. And then you can see here on the right, we also had significant parapet damage where we had previously just thought bracing would work. Turns out we had to 100% replace the parapet and then brace it. And then in addition to that, we realized, well, on reinforced masonry, we better tie in these floors to the exterior wall as well. So some of our completion photos I'll highlight where you can see that. And then this was just kind of some debris in our courtyard from the parapet falling down. And then one other item that's not pictured here, kind of a historic highlight to the building, but there was in this is the courtyard at Jackson. It's kind of in a U shape. There's a subgrade boiler room, and there was this big, vast, dark room that it was deep. And so that's where they used to store coal back, you know, early on. And along the top of the room, you could see the track still where they had used a bin to load the coal in and then carry it down to where an old boiler once was. So I thought that was pretty incredible, but that unfortunately was another impact of the earthquake. That room was no longer structurally sound. So we needed to do what we could to make sure that was safe for everyone. So just to highlight, here are some before pictures of Jackson. This is the building exterior on 200 South, which may look familiar to some of you. Here's a typical kitchen, you know, dated, typical bathroom. So not only that, but the building's old, you know, systems are close. They're either failing or they're close to their the end of their useful life. So we knew that this building needed a lot of work to be done to it to properly preserve it and extend its useful life. And now we have our completion photos. So here's where I mentioned we tied in the floors to the unreinforced masonry in this picture on the left. So you can just ever so slightly see those, which is key, as was mentioned earlier. You know, if you're going to do any sort of work on a historic building, essentially you need to restore the historic fabric and replace like for like. So part of our rehabilitation scope was to replace the windows. And so you can slightly see it here, but we did wood windows to bring them back to its historic beginnings. I mentioned systems earlier. So previously there were just through window AC units. We had installed central AC, so mini splits were installed actually on the roof, one for space saving purposes, but two, to meet historic requirements. They needed to be on the roof so you could not see them from the street line. And specifically, they had to be set back at least 6 foot 10 inches. So you could not see them even when you were across the street from the property. We did masonry tuck pointing to ensure that all of you know, the existing brickwork was secure, and if any deteriorating bricks needed to be replaced, it was with a like kind. So it was easily blendable. Of course, you can see the property got a significant facelift with just the color of the paint, but that was something we did have to go to historic to get their approval on the paint color. The building also got a new roof, complete plumbing reline, and then there were some empty spaces inside of the building. There's a connector in the center that holds the elevators. And so we have converted those underutilized spaces for amenities for the residents, which include a fitness center, computer lab, and then a space on the ground floor for a community room and a library. So it's been a pleasure to be a part of this and to really see the transformation. But now I'll hand it back to Greg to discuss the financing structure of how we revived Jackson and historically preserve this community.
Thank you, Laura. So yeah, how did we get here? We had cooperation from almost every level of government and the private sector. So at the local level, we received, the local being the city, we received a loan from the Salt Lake City Redevelopment Agency. At the state level, we had state historic credits. We had tax exempt bonds from the Private Activity Bond Authority. We had 4% credits, which Steve touched on before, from Utah Housing Corp. And at the federal level, we had a project-based Section 8 contract that provided rental subsidy to all of the tenants in place. And then, partnership with the National Park Service for the federal tax credits, the federal historic tax credits. So it really was cooperation of government at all forms and facets. With eliminating any one of those sources, this project doesn't work. So we are extremely grateful for those sources and for the availability of the credits, both at the state and federal level. It really was what fueled the preservation of this asset. Our private partners, we had Key Bank, who bought both the low-income housing tax credits and the state historic tax credits, and provided the tax exempt bond financing, both at the construction permit level as well. Or we can go to the next slide. So we talked about that the property qualified for federal state historic tax credits by its participation in the warehouse district. So it was located in historic district, which is what got us the designation needed for the part 1 of the historic application. We are located in an opportunity zone, which gave us some opportunities to allow for deferral of some capital gains tax that we had here at Hampstead. So I don't know if everyone's familiar with opportunity zones, but there were certain census tracts that were designated, that were disinvested for a good amount of time, that allowed for an immediate deferral of capital gains taxes for about 5 years. And then there was also provisions to write off portions of that gain over a longer term hold. And Hampstead was in kind of a unique position when we approached this transaction, because we had just gone through a corporate reorg, which involved the sale of quite a number of general partnership interests. So there was significant gain in front of the various partners here at Hampstead. So we began to explore ways to reinvest that gain in other projects that we were already involved in. And Jackson just happened to be located in an opportunity zone. So we here at Hampstead formed a qualified opportunity zone fund and invested capital into the Jackson transaction in order to defer some of that gain, and then also to act as a vehicle to purchase the federal historic tax credits. So I mentioned that Key Bank purchased the low-income housing tax credits and the state historic credits, but the principals of Hampstead self-syndicated the historic credits, and we bought them for our own use and injected the equity into the transaction via an opportunity zone fund. So there is a lot of nuances there and how to do that effectively. And the way that we were able to bifurcate those historic credits from the low-income housing tax credits And the state historic credits was by setting up a master lease structure where there was a tenant entity, a master tenant entity that had a master lease from the property ownership entity. And that master tenant entity is where all of the daily operations of the property occurred. And within the IRS code, if there is a long-term master lease, you can elect to pass through the historic credits to that master tenant entity. So Laura, let's actually skip over the next slide, the sources and uses, and let's pull up that org chart, because I think this will be a little bit helpful in illustrating how this worked. So obviously here, complicated org chart. You have Hampstead Jackson Partners there in the middle, which is the landlord. You have Hampstead master tenant entity there, which is the master tenant entity, and you can see that through the master lease, the federal historic credits are flowing to that master tenant entity. Then at the landlord entity, this is where the OZ fund sits. So you have Hampstead Jackson OZ fund, and they are injecting their equity of about 1.7 million. You have Key Community Development Corporation, which is our LIHTC and state historic credit and investor. And as Steve touched on before, they have to take an ownership position. So you see, it says 98.99% equity. They're also taking a 98.99% ownership participation in the project. I should note that, and Steve touched on it too, that with that ownership entity, that's not necessarily how all of the economics flow. So if you're looking at one of these deals and say, oh, I'm not going to give up 99% my deal, that's not really how it works. You're going to give up 99% of the credits. You're likely going to give up 99% of your depreciation benefits. But in terms of how the operating cash flow and residual works, that's a negotiated position between the GP, which is us at Hampstead, and our LPs. So here it was Key. And typically for us runs about 90% of the cash flow and residual benefits go to Hampstead, and 10% goes to the limited partner. That'll be different depending on the GP. You may be able to get more or less, but that's a typical structure for us. So if you're looking at this and saying, I'm giving away my whole deal, it's not really the case. Key here, and we've talked about syndication a bit. Key bought these directly. So they have a large need in Utah for CRA, which Steve also touched on. So they were very excited to invest both in the federal LIHTC and the state historic because it helps them accomplish their CRA needs. They paid $1.04 for the LIHTC, and I think they paid about 72 cents for the state historic credits. So as Steve touched on, we weren't able to get $1.15 because tax laws changed a bit, so our pricing was not as advantageous as his. But still, in Utah, it's a unique position. Our projects across the country are typically averaging about 85 to 88 cents for the LIHTC, and then also for historic. So Utah is in a unique position where there is a very, very strong demand for credits. So back to the master lease structure, it's very complicated. There needs to be a true lease. So the lease needs to be, for it to be able to accomplish the pass-through, it has to be for a length of 80% of the projects or the assets' useful life. So this had an estimated useful life of 30 years. So our master lease is for 24 years. There has to be significant risk. So that master tenant entity is guaranteeing those lease payments. So if there is any sort of deficit, it is the principals of that entity that are fulfilling that deficit, so that the landlord entity is receiving its full rent, and that rent is projected before you close. So we've got a a schedule for 24 years that shows those lease payments, and we have to stick to them. There's no amending the lease or that does put at risk the pass-through. So there was careful consideration of the economics of the project and setting up what that lease payment would be and making sure that that lease payment was achievable. Another big reason for this master tenant lease pass-through structure is that we did not have to remove the federal historic tax credits from the low income basis. So in Steve's project, he did, and that is pretty typical. We've done that before where, you know, we've had one investor in the limited partnership that wanted both the LIHTC and the federal historic, and we did remove it from basis. But here, since we were structuring it through this master tenant structure, the historic credits are flowing through to a completely different entity that is completely disaffiliated from the majority ownership of the landlord entity. So you do not need to remove the historic credits from the LIHTC basis. It's pretty complex. So we can skip to the next slide, Laura, in terms of the key participants. So, you know, we used Novogradac as our accountant / financial consultant partner. They helped us put together these master lease projections, made sure that there was no foot faults anywhere. There's a lot of places that it could go wrong. So you need to make sure that you have the right team in place that is putting together the structure. And then also with the layer of the opportunity zone, it was critical to have them in place, the Novogradac, to walk us through the compliance there and making sure that we were structuring both the investment and the long-term compliance correctly. Legal counsel also very, very important. We used Nixon Peabody. They helped us structure the master lease document and also walked us through all the complicated partnership docs between the ownership and the landlord ownership and the master tenant entity. So they were critical. And then in terms of the more technical aspects of the preservation itself, you know, I recommend using a widely recognized historic advisor firm. We used McCrosty, who I think is now Orion Company. I've known them for my whole career since I was at Bank of America 20 years ago. We push developers to use them as you know, they prevent some of the mistakes that developers make in terms of some of the things that the National Park Service doesn't want to see. Some of the items that Steve touched on with windows and paint colors and all the things, they were a critical participant in this to make sure that we weren't running afoul of any preservation statutes. Then Laura, you can go to the next slide. Just I guess kind of toot our own horn a bit. The achievements, of this project, we were able to preserve 80 units of affordable housing for seniors in downtown Salt Lake City. This was true at-risk preservation. The project had, I think, 2 years left in its Section 8 contract, and at that time, we were taking it market. There was offers abound. We were a nice corner location and right in the path of a lot of redevelopment. We're right next to the post office that's being redeveloped, a big site there. Various new hotels are going up around us or have gone up now. So there was a lot of demand for our site, but we saw it as a critical affordable housing preservation asset as well as a historical preservation asset. So with the outcome, we've got 50 years of affordability restrictions for seniors making $43,000 or less in downtown Salt Lake City. We created quite a number of jobs over the rehabilitation, and we see it as the epitome of a showcase of community support, as I mentioned earlier, with federal, state, local participants. It really was a group effort to get this across the finish line. We've been lucky enough to win a couple of awards. One from Novogradac in their historic rehab awards of a residential development that overcame significant obstacles with both the earthquake, the pandemic, all the things that were thrown at us early in this project. And then Preservation Utah has also awarded us a Community Stewardship Award. So I know we're getting close to time here, so I'll cut it short there. Open it up to questions. Really thank everyone for their time today.
Thank you so much, Greg and Laura. That was awesome. I think that was just such a creative way to structure that. I love hearing about it. It looks like we have one hand raised. Coral, do you want to go ahead and unmute yourself?
I can't find Coral. She might have left, or is she coming back?
Oh, maybe she is gone. No longer has a question. Oh, no, somebody else has a question. Jay, can you unmute Jay? And Steve.
Can you hear me?
Yes.
Okay. So just to be clear on the state tax credit has to be residential, correct?
Correct.
And on the federal level, you have to be generating revenue and have to have tax liabilities.
Correct.
Okay. All right. Thank you.
Thanks, Jay. Steve, did you have something real quick?
Yeah, Greg, on that master tenancy, was KeyBank the end investor in those the federal historic credit, or was it an entirely different entity?
It was entirely different. So it was a Hampstead kind of led entity that was the end user. It was not the exact principles of our operating entity, but it was kind of self-syndicated amongst some of the principals and other high net worth individuals that had a need for that federal tax credit.
Okay, so when they buy that credit, they get that credit. The funds then flowed that were the source of funds for the master tenants master lease. Is that what paid for the lease, or did it just flow back into the project?
Yeah,
I didn't see the arrow flowing back in, so I'm just trying to.
Yeah, it's kind of funky. So there was it was kind of a mirrored structure where the principals of the master tenant were also the principals of the OZ fund. So the equity went into the OZ fund, which then went into the landlord entity, and then the credits were passed through to the tenant entity. And the tenant entity is then just making its monthly tenant rent payments up to the landlord.
Okay, all right. So that, yeah, there is quite a complexity to that, which is one reason we didn't do that. No.
Yeah,
we're a much simpler folk here, but that's pretty cool. But that definitely is something where you need a Novogradac and you need a Nixon Peabody to really help structure that. But that's really very cool that you're able to use the OZ funds and avoid the removal from basis. That's nice. Yeah,
it was kind of a crazy complicated structure that was bouncing around in my head, and then without Novogradac and Nixon and all the various other consultants, we would have never gotten it done. You need that really expertise to come in.
Did you want to talk a little bit more about syndication and stuff?
I think let's hold off for now because we've still got David to talk. But if we have time,
let's do that.
I think we've covered it pretty good though. So but I appreciate that. Thank you again, Greg and Laura. That was great. David,
wonderful, beautiful project.
Okay, everybody. It is a pleasure for me to be on this seminar, this summit with so many august, well-practiced users of tax credits. And I've enjoyed all of your presentations and really consider all of you heroes for the creative ways that you have managed to find to preserve Utah's built heritage. Just as way of introduction for those on this Zoom presentation that may not know who I am, I'm Executive Director of Preservation Utah. And Preservation Utah is the statewide nonprofit that advocates for Utah's built environment. I'm going to talk about the future of Utah's preservation tax credits. And I recognize that time is short, so I'll be as succinct as possible, as pithy as possible in my presentation, but I do have some important things to say to all of you and have an ask at the end of my presentation to make of all of you as well. As a historian, I think the best way to understand the future is to understand the past. And just a little bit of history on our state tax credit here in Utah. We got this tax credit in 1993 during the legislative season of 1993, and it really took effect in 1994. And since 1994, the tax credit has been doing what it needs to do, what it was designed to do. And some of these newspaper articles help illustrate that. Here we have a Herald article from 1994 talking about the creation, the birth of the credit, and the Daily Herald article there in Provo talking about tax credits rehabbing historic buildings, and another one from 2014 talking about the economic benefits of the credit. So, in short, since 1994, really, we have been saving buildings and reaping economic gains through our existing state tax credit. And here are, of course, some of the buildings that have been saved. There again is our friend, the Borden Milk Lofts, Steve's project, which we want to highlight. In short, as you can see by these diagrams, even just in the past 10 years, from 2011 up to the end of 2021, 1,017 projects have been approved across the state for historic preservation tax credits. They have reached nearly a third of Utah's counties and have generated upwards of $149.8 million in private investment. Other tables help sort of break down those numbers into even more comprehensible figures. For every $1 million invested in rehabbing buildings in Utah, we get 10.2 direct jobs, 7.5 indirect jobs. You know, I'll let you just look at this list and understand the value of this credit and what it has done for Utah since it was created in 1993. We love our tax credit, but there is room to improve it. The rest of what I'm presenting on today. We go back to this article that was published at the birth of the credit. We see in the last main paragraph of this article, the statement, the credit is not available for any properties used for commercial purposes, including hotels, motels, et cetera, et cetera, et cetera. We want to change that. This has been a dream of Utah's preservationists since we received this initial residential state credit back in the 90s. And the stars have really aligned at the present moment to achieve this goal. I'm going to skip this for the interest of time. Why add commercial properties? I think for most people on this call, is if we add more commercial properties, we just get more great tax credit benefits, investment in local economies, and we save more great buildings. I can make this information available to everyone on the call through the Preservation Utah website at a later date. But as I was saying, the stars really aligned, starting with last year, to expand our residential state tax credit to include commercial buildings as well. And a group of advocates, and especially the Utah Cultural Alliance and Preservation Utah, in conjunction with SHPO, I want to stress that there's a big white gap between Utah Cultural Alliance, Preservation Utah, and SHPO. SHPO is a branch of government, so they cannot be advocates, but they can provide those of us in the advocacy camp with necessary information about the value of the credit, what the credit generates. And so that is their role in expanding this tax credit. So Utah Cultural Alliance, Preservation Utah, mayors, businesses, county commissioners, all gathered together at the beginning of this year to expand the tax credit. And basically what we asked for in this expanded tax credit at its core is a 20% income tax credit for residential and commercial buildings. Right now, it's just residential. We want and commercial, and then a new FTE or another Amber Anderson, in other words, to manage the commercial credit. You know, there's some nuance beyond that, but at its core, that's what we are asking for. Again, this new commercial tax credit will be applied to qualified buildings listed on the National Register of projects exceeding $10,000, et cetera, et cetera, et cetera. So we got this through House committees. We got this through Senate committees. We got it through the House, and then it went to the Senate. And this was such a heartbreaker. I think Amber and I were looking at watching the feed of the Senate the last night of this 2022 session. It was reaching midnight, so the session was about to end. Our tax credit bill was the next one to be voted on, and they called the session. So we almost made it, but not quite. This headline, Utah lawmakers wrap up 45-day session in dramatic fashion, doesn't necessarily refer to the tax credit, but for those of us preservationists, that was the drama of the last moments of the 2022 session. So we didn't get the tax credit expanded, but we are well positioned, and with our camp of advocates and SHPO helping us with fact-based questions, we are in a great position to ask for essentially the same package of requests that we came to the legislature with this year during the 2022 session. So that is essentially my presentation, but I said that my presentation would end with an ask. And the ask is, will you, everyone on this call, committees that you're on, organizations you represent, even if it is, you know, the organization for, I don't know, snowmen against global warming, or the Society of People Who Happen to Be Born. You know, we're not going to be exclusive in you know, expanding the tent to invite people to help us get this new commercial tax credit. Anyone who can write a letter, who can make a phone call, who can engage their elected officials is welcome to help us expand our tax credit to include commercial buildings, which would be a tremendous boon for Utah economically and, of course, on the historic preservation front. Another ask I'm going to make is that you help us find a House sponsor for our bill. Our Senate sponsor is Darren Owens, and this past session, our House sponsor was Timothy Hawks, but he retired. So we are in search of a House sponsor. If anyone has any ideas about who that may be, reach out to me at david@preservationutah.org, and I'll be happy to process your feedback. Again, if you also can help us with this expanded tax credit, please also reach out to me at the same email address, and I'll be glad to receive your communication. At any rate, that is my presentation in a nutshell, and I'm noticing we are 5 minutes over. I appreciate everyone paying attention, and if we have any questions, I'm happy to answer them.
Thank you, David, and thanks everybody again for attending. Sorry we went a little bit late. We will be sending the recording out to all of the people that registered. Thank you to our speakers. This was super informative. This is a really great group of people and doing very creative things with tax credit financing. I realize people probably have to leave, but if we do have any more questions, I don't see any hand raises or anything at the moment. Give it a few seconds, but otherwise, thank you for joining, and we will be in touch.